This $29 book made me an accidental profitable trader. I've been trading for 8 years now. In the first 3 years, I was losing money every month buying calls, puts, trying to predict where stocks would go next. And then I came across this $29 book. Everything changed. And within 2 months, I was profitable. And within a year, I was trading full time. And it was all due to this book, Get Rich with Options by Lee Lowell. And we're about to go dive into it in this exact video. Now, the biggest shift I had was I stopped buying options and started selling them, and I stopped predicting and started using probabilities in my favor. So the core idea of the book is that most traders lose because they buy options, or they buy based off speculation, right? When you buy options, there's low probability. You need the stock to move in your direction, and you also need to happen fast, right? If you're just buying random shares, you only need to be right in direction. But if you're buying options, you have to be right in direction and time, which makes it way harder against you. And because of that, 75% of options are going to expire worthless anyways, which is why there's a huge higher probability making money by selling options, because time decay works for you. You can profit if the stock stays flat or moves in your direction, and you're no longer the casino or the gambler. Or sorry, you're the casino house edge. You're no longer the gambler. So the book's 4 core strategies have these 4 that it covers. So covered calls, cash secured puts, collars, and vertical spreads. I'll be honest, a lot of these 3 are more for like longer term investing. You can still make some decent weekly options, but the biggest takeaway I got was actually from vertical spreads, which have defined risk but high probability setups. So I'm going to show you strategy 1 to 3, quick overview. Covered calls is basically when you own 100 shares and you sell a call, it allows you to collect premium. That's going to generate income on stocks that you hold. Cash secured puts are kind of like the opposite. If you want to buy a stock at $50, you can sell a put at $50 and collect that premium. And if price dips lower, then you're going to own those shares and still be buying at a discount. Collars are a little bit different. So if you own stock with gains, what you can do is buy a protective put and then also sell a call, which will allow you to lock in profits without selling. And all of these work pretty good. They work great. But strategy number 4, spreads, was my breakthrough. So this is where everything clicked for me, right? And vertical spreads are essentially where you're able to sell an option so you can collect premium, buy an option that's further out, which will protect you, and that's going to result in a defined max risk, high probability profit. And they're very powerful because you can collect premium, but your risk is capped. So you kind of get the best of both worlds. Now, credit spreads are my go-to strategy. And by selling credit spreads, you're going to be able to collect that premium with that protection. So there's 2 types of spreads that I'll trade. One of them is a bull put spread, which is a neutral to bullish strategy, where you're going to sell a put at a lower strike and then buy a put at an even lower strike. And that way you can profit if the stock stays above your sold strike. Now there's another one called a bear call spread, which is the opposite. It's a neutral to bear strategy. So what you're doing is you're selling a call at a higher strike, you're buying a call at an even higher strike, and that way you're going to protect yourself if the stock stays below your sold strike. You don't need the stock to move your way. You just need it not to move against you. That's the key ticker right there. So here's an example on a bull put spread on SPY. Let's say SPY is trading at $460. So what you would do is sell the 450 put, so under that one by about 10 points for $150. Then you're going to buy the 445 put, so 5 points under the sold put that you sold there, for $80. You're getting a net credit of $70. Okay, that's actually the broker essentially giving you money because you're getting a credit. So $70 is going to be your max profit. Now, if SPY stays above 450, that's where you're going to collect all of that $70. Now, if SPY drops below 445, your max loss ends up being $430. Now, you may be saying, Jordan, that's not a good risk reward, right? I'm risking $430 just to make $70. But you get a huge advantage in the fact that SPY is currently at 460. In order to take a loss, you need price to go all the way down under 445 or under 450. So you basically need the price to drop, I don't know what that is, like 2%, 4%, in order for you to lose money. So if price stays where it is, if it drops 1%, or if it goes any amount upwards, you're going to profit no matter what, right? And so that's the edge, right? SPY can still drop $10 and you're still going to profit. It can stay where it is or it can go up and you're still going to make money. Now, another example would be a bear call spread on NVIDIA. So let's say NVIDIA is at 480, and this one's the opposite, right? So you're going to sell a $500 call up at $200, or for $200 of premium. You're going to buy the 505 call for $120. That's going to allow you to get a net credit of $80, right? Max profit $80, max loss $420, but your probability of profit is 70%, right? So NVIDIA can still go up $20 and you're still going to profit. Or the market can crash and you're still going to profit. Or it's going to stay flat and you're still going to profit. That's the advantage of this strategy. Now, iron condors are another strategy you can use that I use a ton in my trading, where you basically double up the premium. So that's when you get a bull put spread and a bear call spread at the same time. So let's say that same example on SPY, right? It's at 460. You can sell a call spread above it and get $60 in credit, and you can sell a bull put spread below it and get $70 in credit. That means you're going to get a total credit of $130. Now, if SPY stays in between that 450 to 470 range, that's a $20 range, you're going to make profit. Your max profit is going to be $130, your max loss is $370. And that's going to allow you to make money when the markets are flat or choppy, you're not really doing anything. And this is really easy, simple trades. You get very high probability setups, and just a few of these per month can add up to a bunch of consistent income. Now, here's why spreads changed everything for me, because before, when you're buying options, you simply just get screwed on time decay. Everyone watching, you've probably done it. I've done it a bunch. You'll buy an option, the market will stay flat, and you'll just be down 10%, 15%, 30% in a matter of a few hours simply because of time decay. The win rates are typically pretty lower, and it's typically higher stress. Selling, you get to take all that advantage in your favor. Now you love time decay. You love when the market's choppy and not doing anything, because you simply just profit off of that. You have higher win rates, lower stress, and you can generate a lot more consistency by doing that. And that was one of the biggest shifts I got from buying to selling. It wasn't necessarily changing my strategy, just changing the vehicle I use to profit on that actual method or strategy. So the big mindset shift, stop trying to predict big moves, start collecting premium. Instead of thinking, oh, Apple's going to go to $200, I'm going to buy calls, think Apple's probably not going to drop below 170. I'm going to sell a put spread and collect premium. And you can still profit on that same exact move. And the reason is because math is always going to be on your side, right? There's always going to be time decay against you. Every day that options move, they lose value, right? And your probability is going to be a lot higher when you're selling options, 70, 80%. You're going to have defined risks. You know exactly how much you can lose or make on every single trade. And there's a lot of different flexibility, in the moves, right? If price goes up, it stays flat, or it goes down a little bit, you can profit on every single direction. And this is how market makers make money, right? They simply sell premium, hedge, because they are the ones taking the opposite side every time that you or retail traders buy an option. They are the ones selling. And a lot of common misconceptions, selling options is too risky. And yes, if you're selling naked options, it's pretty risky. But if you're selling spreads, all of your risk is defined. You know exactly how much you can lose on every single trade and control it. You need a huge account. That's not true. You can start with just a few $1,000s. I only started with like $3K in my account, and that allowed me to continue and compound from there. And it works in all markets, whether it's going up, down, neutral. In fact, I find that, especially with iron condors, it works best in neutral markets. You don't need to be an expert. That's the craziest thing. All you need is rules, a simple strategy, and discipline. And here are my real results, right? In the first month after learning and reading this book, I simply started with credit spreads on SPY, right? I made a few $100 the first month, made about $500 the second month. It's not much, but on a small account, that tends to add up. And then after a few months went by and I was seeing success, I started to add in iron condors. Then I started averaging a little bit more. And then after the first year or so is when I started scaling, making more than what my old job was making me at the time, making a few $1,000s a month. Again, I wasn't doing anything crazy. I didn't have some secret indicator. I simply just switched from buying options to selling spreads, and that was the huge direction I got from this book. And here are simple rules I follow that, if you want to take them for yourself, you can as well. I would only trade high probability setups. I would always use spreads, never use any naked options, never risk more than 2 to 3% per trade. I would usually take profit at 50 or 60%. A lot of people like to wait and get that max profit, but I find that if you're up 50, 60%, take that. Let it work for you. In the beginning, I was doing a lot of 30 to 45 days to expiration trades. Now I do a lot more 0 DTE, 1 day setups, things like that. I was trading SPY, QQQ, and yeah, that's really just it. As long as you have a strategy that works, you don't have any emotions, and you follow it, that's how you're able to profit consistently. And again, selling options changes your psychology so much. Because I remember when I was trading options and I was buying them, I was always in this issue of, oh, I need things to happen fast. I need it to happen now. Otherwise, I'm going to get screwed by time decay. And now it's the complete opposite. Now I can trade my exact same strategies and have no issue at all if it takes forever for the trade to occur. If it takes a day, a week, it doesn't matter, because now time decay is my friend. So 3 keys I've changed in my trading: sell, don't buy, use spreads or defined risk, and focus on high probability setups, not home runs. You don't need to try and get a 5% win rate and go for these 10R, 20R trades. You simply need to find a system that works for you, works for your psychology, and can allow you to have consistent income. And the playbook already exists. You don't need to reinvent any crazy strategies, but using the same strategy you have right now, I bet if you are buying options and you start to sell options instead, there's a good chance that it could increase your EV and make you a lot more profits. Hope you guys did enjoy this video. Please subscribe. I have new videos coming out all the time. This is a new channel, and we're going to ramp this up with a lot more content. So feel free to subscribe so don't miss any other videos, and I'll see you all in the next video.